Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of CNBC-TV18 Bazaar Morning Call. And the CNBC-TV18 logo, as you can see up on your screen, it's a new one. We bid farewell to the peacock, which of course has been, the calling card for CNBC-TV18 for the last 20 years now. And this is the new logo. Same team, same content, same analysis, but you got a different logo as we get on to the next chapter. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, Nigel and Rima with me, guys. Morning.
Hi, morning.
Hi, morning. It's a short but a very important week. There's so much to digest. A dangerous widening of the conflict, complete risk-off across markets. There is rupee action. There's been RBI regulatory intervention by the RBI. So there's lots to think about and digest this morning.
Well, not such a bad week to have a few holidays, right? And hopefully the news flow improves when we come back on next Monday. But for the time being, things didn't get a lot better over the weekend. But Rima, I thought you'll mention about Mumbai Indians. Finally, we got off to a winning start. So that was encouraging as well in terms of the IPL action. But we've got markets to look at. So let's hop across first to Prashant, who's going to be telling us all the cues that we've had over the weekend. Prashant, take it away.
Thanks very much for that. So just think about it, right? 28th of February, that Friday, it was actually Saturday morning for us when we first woke up to news that Israel and US have attacked Iran. And many said, well, this is Venezuela 2.0. This is going to be short-lived. It's going to be temporary. Well, absolutely majorly miscalculated. And that was basically the bulk of the market, if you remember the first few days. And now it's the fifth week. Basically, a month has passed and there's no end in sight. The problem is this, right? Something or the other, and there are too many parties involved and everybody needs to pull back. And there are new parties which are now getting into the fight. So you've got, and this is the latest. I'm just trying to wrap up what is new in that sense, and then we'll get to the same or the old in terms of price action, etc. So Brent oil prices have jumped to actually they're now closer to $117. They're up on your screen, almost $117. The Houthi rebels, which is basically a Yemeni group, and they are large. They have been over the years supported by Iran, and they've considered one of Iran's proxies in the region, in the Arab states in the Middle East. They have now formally joined the escalating conflict. If you look at a map, Yemen is essentially adjacent to Saudi Arabia, and it is also close to important waterways. And I'll tell you why I'm saying this. Houthis, by the way, launched ballistic missiles at Israel. Some are saying, well, this is just performative. They're not really getting into the fight. They would just want to show that we are there. They don't want to. They don't want to escalate this because otherwise Saudis are going to hit them hard. U.S., Israel, everybody's going to hit them hard as well. So this is performative more than anything else. But in any case, the reason I think the markets are a little nervous is because in any case, the Strait of Hormuz was blocked. If you look at a maritime map, right, of that region, one is the Strait of Hormuz through which bulk of the oil passes. That's in the Persian Gulf. The other one is basically between Yemen and the African continent. It's a very narrow pathway, and that is important. The numbers are, we will put out the numbers later in terms of how much oil passes through that strait. But with the example of what Iran has done in the Strait of Hormuz, is it possible that Yemen perhaps is going to do something similar in that strait, right? So Africa on one side on the west and Yemen on the other, Yemen on one side. And this has got immense implication if that strait is blocked, or they try to block it, because Saudis have been saying, well, we won't take oil through the strait. We're going to take it through the east-west pipeline, and then we'll bring it down to deliver to Asia through the strait, which basically passes through the shoreline of Yemen. And if Yemen is able to block it, I mean, you are essentially looking at one more large oil shock. And I think that is largely the reason why you've got oils at about $117 or so. That's what I want to sort of put out. That's the new thing in that sense. Second, right, and this is something to do with the market here, the RBI and the rupee. The rupee, of course, hit almost $95 on Friday. Post-market hours, I think it was about 6 or 7 in the evening, the Reserve Bank of India essentially said that they're putting a $100 million cap on banks' net open positions in the rupee market. And the banks need to unwind existing positions before the 10th of April. Banks basically have an estimate, and these are estimates, about $40 billion in these short-term Forex exposures. You know, the trade was very simple. You go long the dollar rupee here in India, and you go short the dollar rupee overseas. The difference used to be 2 paisa, 3 paisa, and it was almost free money. That trade had ballooned. There were limits on a net basis, but there were no limits on the gross basis. I mean, the trade became very, very large. There would be about 8-10 banks who would be part of this. I mean, if you look at this $40 billion and who's got exposure, it would be 8 to 10 banks. There'd be mixed of public sector and private sector and foreign banks as well. So PSUs, private and foreign banks, but it's largely limited to about 8 to 10 banks. So today, this morning, because the RBI said you will have a $100 million limit, what will banks have to do? They will have to essentially come into the market, sell dollars in the onshore market because they are long dollar. They have to unwind by selling dollars. And because they are short dollar rupee overseas, they've got to buy dollars overseas. And what basically will happen is that the dollar will appreciate. We are close to 94.81. I mean, I think you could see a 1 rupee appreciation against the dollar straight up. And some are not ruling out that the rupee goes up all the way to about 93.50, even 93. Who knows? We'll see how that really plays out. So that's a big one which has come through. US markets, I'll just quickly wrap up. S&P 500, 1.7 lower. NASDAQ was down about 2%. The 10-year yield, 4.43 is where we left off. It's up 45 basis points higher since the war began on the 28th of February. And that's a big one. That's a 2 standard deviation move in that sense. Now, war timelines, and this is just commentary. Secretary of State Marco Rubio on Friday saying that U.S. war on Iran will take weeks, not months. Washington Post reporting that U.S. is preparing for weeks of ground operations in Iran. And, of course, an additional 3,500 U.S. troops are already in the Middle East. And, by the way, you know, President Trump had given the 6th of April deadline. Guess what is on the 6th of April? 2 additional U.S. warships are getting into the region. So some are essentially saying this is just a pause before you see another further escalation. We'll see if that is really the case. There are some, President Trump has spoken on board Air Force One, and we'll put out some quotes from President Trump. And he's again sort of, sounding the de-escalatory noises and saying, Iran has accepted bulk of the 15-point resolution, et cetera, But, see the social media post of the Iranian Speaker of Parliament this morning essentially saying that, well, nothing has been done and this is just, trying to manipulate markets more than anything else. I'll just leave you with levels. Nifty supports at 22,624 and then 22,200. I mean, we could put a downward sloping channel and maybe explain it a little later, but these are the numbers on that channel. And the resistance is 23,186 or so. So that's the overall picture. Gift Nifty, I think, indicating a 240-odd point lower start. Well, F&O positioning, how does it look like as we start in a new week? Nigel, take it away.
Well, today marks the end of the March series as we play out the monthly expiry. And it's been a forgettable series for the bulls, marred by geopolitical tensions. The Nifty Bank, both of them are down between 10 to around 14%. On Friday, though, the Indian markets pulled back very sharply. But that's been the trend, actually, for global equities. However, if I pull up the net institutional sell number, that number was actually only around 1,000 crores, or actually a little below that. That clearly tells you the mood of the market. It's lack of buying rather than intensified selling that's causing stocks to crack big time. The FIs, yes, there have been sellers in the cash market, but the quantum of selling was not so large to see the kind of session that we saw in Friday's trading session. Sometimes these sort of periods provide opportunities for longer-term investors, so just keep that in mind. Well, the FIs, they've been defensive on the derivative side of things as well. On Friday, they added shorts both on index as well as stock futures. And now their shorts stand at around 2.8 lakh contracts, which is approximately 85% on index futures side. The FI call writing, well, that continues with close to around 3 calls being written for every 1 put in Friday's trading session. And there was writing being seen at 23,000 call, 23,100 call. The premiums on both those two, they eroded sharply as well. But today, it's going to be more about defense. and the bulls will look to defend last week low, which comes in at around 22,471. And the hope is we don't go all the way down and breach Liberation Day low of around 21,700 in the coming sessions. I think something's got to give, and the street will be hoping for taco. This as Trump seems to have pushed himself in a difficult corner. The war getting prolonged longer than expected. The yields are up by close to around 40 basis points. Brent crude prices as well are bringing inflationary worries back on the table. And this is the combination actually Trump would not have wanted on their wish list ahead of a midterm election. So that's going to be important. The taco is something that people will be hoping that actually Trump pulls back a little bit. So, either things get a lot worse from here on, or we're getting in for a very, very ugly phase for global equities. I would lean more towards the former as of now, that maybe the downside from here on is actually limited. The Indian rupee as well will see some relief because the RBI has put that $100 million cap on banks' net open positions. But this will impact the MTM book of banks. So we can expect a start closer to the recent lows on the Nifty Bank, which is ballpark around 51,500. Defending this mark is going to be extremely important from a bullish perspective. So monthly expiry, a gap down opening, and hopefully some strength on the rupee. You got plenty of action today. Hope is that at least we end off a little bit better than where we start off. But going by the global equity market screen, it's looking like a tough session.
Well, the Nikkei, that's the Japanese index, is down 4.7%, so now approaching a near 5% fall. The Korean markets are down 4%. The Taiwanese markets and Hang Seng, both of them are down nearly 2%. It's an ugly, ugly, complete risk-off session that we can see across Asia. Taiwan has now extended the fall. It's now down over 2%. On the equities then, it's Chetan Seth of Nomura who says that they continue to retain a cautious near-term stance on Asian stocks, as the Iran war has now entered the fifth week without any signs of normalization of energy flows from the Strait of Hormuz. He says while there have been diplomatic exchanges between the US and Iran to reduce tensions, both sides appear to remain far apart to agree on any mutual de-escalation. He says in Asia-Pacific ex-Japan equities in the near term, he continues to be cautious on Indian equities, where he sees an earnings risk, elevated valuations and twin deficits. Also, he's cautious on Indonesia and Philippines, where Nomura says that both twin deficit countries. But in the case of the other two countries, Indonesia and Philippines, valuation risks are lower versus India.
Okay, well, Samina Chakrabarti of Citi says that the ongoing conflict in West Asia has again put the spotlight on important inflation and energy exchange rate pass-throughs. He says they've tried to recreate the RBI's imported inflation index with the new weights from the recently announced 2024 base year CPI. He estimates that 14% would be the adjusted effective weight of the imported inflation basket, out of which petroleum products would almost have half the weight of 7%. He adds February 2026 imported inflation was 7.5% year-on-year and contributed 34% of headline inflation, and sensitivity of headline CPI from a 5% depreciation in rupees estimated at 35 to 40 basis points, assuming sticky ingredient petrol product prices. Samir adds, as during the Ukraine conflict, WPI is likely to bear the brunt of imported inflation. He says 80 to 120 basis point upside, risks the nominal GDP growth forecast of 10.5% for the FY27, arising from the possibility of a sharp rise in WPI if the conflict endures.
Meanwhile, speaking to reporters on Air Force One, the US President Donald Trump has claimed that Iran gave the US the most of the 15 demands it issued to Tehran to end the war, even as it remains unclear whether either side is negotiating. Listen in.
They gave us most of the points. Why wouldn't they? They make it sound like they made some concessions. Can you identify it over? Well, they're agreeing with us on no land. I mean, we asked for 15 things, and for the most part, we're going to be asking for a couple of other things. And just to prove that they're serious, they gave us all these buffs. When I talked to about 4 days ago, a presenter said they gave me a present, but I didn't think I was at liberty to say what it was. What it was 8 plus 2. It's 10 massive boatloads of oil. And today they gave us another present. They gave us 20 boatloads of oil that starts being shipped tomorrow. We're having very good meetings, both directly and indirectly, and we're getting a lot of very important ones.
Well, at least for now, both sides still seem to be talking past each other. There are no signs of de-escalation. 2 days back, the Iran parliament speaker also went on to say that they've spammed us with so much fake news, trying to push energy prices down, that the market is now just numb. William Lee, chief economist and managing director at Global Economic Advisors, is now joining in. Thank you very much, William, for joining in. Do you get a sense that we've seen a dangerous widening of the conflict? 3,500 U.S. troops have arrived. Yemen's Houthi militants have now joined the conflict. How are you reading the latest signals?
I know the standard scenario is that we are going to be looking out for the expansion of fighting. But I think a slightly different perspective can be put on the picture. What we are sending are troops, in fact, quick reaction forces, Marines from Asia into the Iranian theater. And my expectation is that a lot of these military actions will be very surgical, as they have been up till now. I think the United States has gone out of its way to contain the fighting from affecting the Iranian population very much. It mainly has been centered on getting rid of the command and control centers, getting rid of the governance structure, especially among the extremists and the extremists on the military side. Right now, I think much of the facilities, for example, in the regular army has been left alone because they have not shown the kind of radical impulses that the Iranian Guard has shown. So I expect that if we are going to have troops on the ground, it'll be much more of a surgical strike. It'll be to contain the ability of Iran to export oil, and that means Karg Island. I think the whatever is done is going to be one of limiting the ability of the existing government to do business as usual, to make them much more willing at the bargaining table to come to a quick conclusion. I think that's the strategy that is going to be revealed over the next several days and couple of weeks. Because as you've all said, President Trump is under a very short fuse. He has to wrap this up before the midterm elections become into view. And within the United States, we are still far enough away from November that he has some time to operate. But sometime by late spring, early summer, this stuff has got to be wrapped up, or else it's going to influence the ability of the Republicans to retain control of the government. So my expectation is that the military actions from here on are going to be very surgical and directed toward limiting the ability of the existing government to do business and to incentivize them to be much more serious in their discussions.
You know, I've been, William, hi, morning. I've been saying this since for at least 6-7 days now. But there are more, that this is the beginning of the end and this will wind down. And but point is, there are more troops in the region now and more are coming, right? 6th of April, there are two large warships reaching the region, which is the deadline. So this is just kind of sort of, you know, attempts at having a better negotiation, a handed negotiation with all this military might, or you think this actually leads to more escalation?
Well, it depends what you mean by escalation. The Houthis have escalated. They've fired a couple of missiles off, but again, they could have done a lot more.
But if you, William, if you read it, this largely seems performative. They've hit 2 missiles and that's it, right? And they were intercepted, and that's about it. Nothing more. Yeah, go on.
Remember, the ability of the Iranian government to fund the Houthis has been cut off dramatically. And all, as President Trump was saying, he had to get a confidence building measure on the part of those he's negotiating with to make sure that they really are the ones in charge. That's why there's been some demonstration of, yes, we do control the Strait of Hormuz. We can allow ships to pass at our discretion, and we're going to demonstrate that to you. I think that is a very important demonstration that we're talking to the right people. Now, there are the wrong people still floating around, and they can do a lot of damage. And I think the military will be directed toward getting that other part of the non-government extremists under control. And I think whatever military actions you see will be much more oriented toward containing those elements.
Okay, William, we leave the conversation here for now. Thank you very much for joining in. Let's move on and tell our viewers the interactions that we've lined up on the show today. 8:35, Dinesh Khara, former chairman of State Bank of India, and Abizar Divanji of Neostrat Advisors will join in as RBI looks to curb net open positions of banks in the Forex market in a move to boost the rupee. At 9 a.m., we'll be joined by Jayesh Mehta of DSP Finance. The rupee markets will open at 9 a.m., so we'll discuss the moves and the recent RBI circular. At 9:20, we'll be joined by Gautam Chowcharya, Tanvi Gupta Jain, and Divya Nagarajan of UBS to talk about the geopolitical tensions and the impact on the Indian economy. The entire top team of UBS will be here with us. 9:40, the management of IRFC, Indian Railway Finance Corporation, will join in to talk about the 12,800 crore of a rupee loan deal with Hindustan Urvarak Rasayan for debt refinancing. And following that, Saurabh Mukherjea of Marcellus Investment Manager will be chatting with us at 9:50 to talk about his recent book launch. End of the show, Lata will be in conversation with Neeraj Gambhir of Axis Bank and Abhishek Upadhyay of ICICI Securities Primary Dealership.
Time to slip into a quick break. We've got a lot of stocks that we'll be tracking for you. So take that break, come back. We'll get into further detail on all the top names.
Welcome back. Let's talk stocks now. This is CNBC-TV18's list of top stocks for the day. And the big story today is going to be on the rupee and banks. The RBI has capped the total positions that banks can take in the onshore currency market at $100 million. So banks will have to bring down their positions to that level by 10th of April, $100 million. What does this mean for the rupee and banks? Lata now joins in with more. Lata.
Yes, this cap on FX positions that banks can hold in this market, that is onshore market, not NDF, that has been capped. Until now, or actually the ongoing rule is banks can have net positions of 25% of their tier 1 capital, which means big banks can have more net positions and smaller banks, smaller positions. But remember, it is always net. See, you can have any $1 billion, $2 billion of positions which are countered by an opposite position in the NDF market. Usually it's long on the onshore market and short on the offshore market. And then it's only the net that is capped. For the first time, what Reserve Bank is capping is the gross position itself, which can only be 100 million. I mean, that's far less than what banks would have been prepared for. And so what would the market have to do? They have time till April 10th, but everyone will rush to the door first, is the expectation. So obviously, in the morning, the expectation is that you're going to see a rise in the rupee. We don't know whether it will be 93.50, 94, but there will be a fall from that 94.80 level that the dollar was selling. Some people are even talking of 92, but okay, there can be random noises like that. While they, unwind here, they will have to buy in the offshore market. And therefore, the level difference between the offshore market and the reference rate, at about 11 o'clock, 11 to 11:30, you have the reference rate. If that difference is too much, that accounts for the loss that banks have to bear. Now, the talk in the market is there are $40 billion of positions. Again, only Reserve Bank knows the exact amount. I have got this from the chatter in the market. If it's 40 billion and there is a loss of 1 rupee, it can amount to a loss of about 4,000 crores for the entire banking system. But we are talking ifs and buts. There is still a hope. There's about 35 minutes for the markets to open. Will the Reserve Bank still extend the date to, say, April 30th? Even if they give 1 month, most of the contracts are 1 month contracts. And therefore, the banks don't have to rush to the door and sell. It looks extremely unlikely that the Reserve Bank ever walks back on what it has announced. But there it is. Otherwise, potential losses, whether the losses will have to be taken in the 31st March quarter or next quarter, even that is a bit of a grey area. But if the rule continues, losses are there.
All right. Thanks a lot for that, Lata. Well, I'm looking at the metal stocks and aluminum stocks in particular. This has, over the weekend, following an Iranian missile and drone attack, Emirates Global Aluminium's Al Tawaleh site was damaged, and an assessment is ongoing. Now, why is this facility important? Because Emirates Global Aluminium's Al Tawaleh produced close to 1.6 million tons in the last calendar year, that's 2025. Now, part of this facility will be impacted. That, in turn, will support aluminium prices. And this already adds to the recent supply cuts that we've seen in the Middle East. Remember, Qatalum, they pulled back close to 250,000 tons of production. Aluminium, Bahrain as well, curtailed close to 300,000 odd. So between them, there is already 500,000 tons that was out of the system. So this fresh hit actually will further pull back some supply. The ongoing war in the Middle East, well, it risks a lot of aluminium capacity. Remember, the Middle East accounts for roughly around 9 to around 10% of global output. But more importantly, they export a large part of this production. So in short, the supply crunch gets a little bit more, and that in turn could support aluminium prices. So we'll keep an eye out on all these aluminium stocks today. But let's, we'll also keep an eye out on Coal India because they won an LOA for 750 megawatt of BESS project in Telangana Genco. And the total project cost is roughly around 1,000 crores or thereabouts. They've been talking about diversifying a little bit away from the core coal business. So this as well, a bit of a positive is the way I look at it, though the core business actually will get a significant leg up in terms of the pricing that we've seen in the international markets. Keep an eye out on Coal India as well. But let's go to Ria. She's here to tell us about the defense stocks. Morning, Ria.
Well, good morning, Nigel. Defense stocks today will be in focus as on Friday, the DSE cleared proposals worth nearly 2.4 lakh crores. Now, in terms of the key projects for the Indian Army, they've cleared the air defense tracked system as well as high capacity radio relays, both of which Bharat Electronics will be the key beneficiary. They've also cleared proposals for the runway independent aerial surveillance systems. And for this, Idea Force stands to benefit in addition to some other private companies as well. For the Indian Air Force, we have the remotely piloted strike aircraft as well as the Sukhoi 30 engine overhaul, and out here HAL will be the key beneficiary along with some other private players as well. And for the Indian Coast Guard, heavy duty air cushion vehicles have been cleared, and for this one Garden Reach Shipbuilders as well as Goa Shipyard will stand to benefit. So overall 4 key stocks will be in focus: HAL, Bharat Electronics, Garden Reach as well as Idea Forge.
Okay. All right, thanks very much for that, Ria. Well, urban companies, the next one we're going to focus on. Mangalam has got details on this one. Mangalam, morning.
Good morning. So it's been a big correction from the highs at lows. There was fund buying, etc. The big story for the company is how Insta Help for them actually scales up. And there is an update which has come on that. The company has crossed a monthly run rate of over 1 million orders on Insta Help. And we still have a few days left for March. And this is a big positive because they hit the milestone of 50,000 plus orders per day in February, and they're scaling up on that as well. For a business that started just a couple of quarters ago, has swiftly become a big total addressable market and attracted competition as well. The only couple of parameters that we watch from here on: one, the company had earlier promised that losses per order in InstaHelp will reduce. So will that happen or not? And secondly, you have players like Pronto, Snabit, all of them raising money from the private equity world as well. How the competitive intensity will play out. So not very different from what quick commerce was earlier, now that these quick services are coming in for platform companies. But by and large, given the weakness of the market, the stock could see some red, but news is fairly positive.
Thank you very much for that. Sonal now joins in with the latest on ONGC and Oberoi Realty.
Well, let me start with ONGC because their Daman Upside Development Project has started commencement in terms of monetization of gas. Remember, they say this was a capex of $1 billion that the company had made. They say it will be the production from all the wells will be ramped up in a phased manner. We don't know the quantity of gas that will be produced from there, but it is a step in the right direction. Oberoi Realty, it's another redevelopment project that the company has entered into in South Bombay at Pedder Road. It is a total free sale area of 4,800 square meters, and the company has been looking at redevelopment in South Mumbai. It's another addition here. The stock will be on our radar.
Okay, all right. Thanks a lot for that, Sonal. Well, let's go back to Ria. She's here to tell us about another stock that she's tracking, that's EPL. Ria?
Well, Nigel, EPL will be in focus today as they have announced their merger with Indovida. Now, they will be creating a consumer packaging company for emerging markets post this merger, and this will form a $1 billion revenue entity as per the company, and the combined valuation for them will be $2 billion. Now, if you go deeper into the valuation, the transaction has valued EPL at rupees 339 per share, which is 70% higher than Friday's closing price. And if you look at Indovida, that is valued at a 35% discount to the multiple that was ascribed to EPL. Now, in terms of the shareholding post the merger, Indorama Ventures will become a co-promoter of the company, holding roughly 51.8% stake, and Blackstone will continue to hold 16.6% stake in the merged entity. Now, this merger is also expected to be EBIT margin accretive by roughly 120 basis points and also ROCE accretive for EPL by around 220 basis points, and this transaction will be completed within the next 12 months.
Thank you very much for that. More news on Thermax. GR Infra, Upasna joins in.
Good morning. First up, let me start with Thermax. Now, the company has secured a boiler packet supply order worth 1,600 crores from Thermal Power Project Company in the central India for an ultra supercritical thermal power plant. Now, mind you, this is the second order that the company has received in this month, and with this, the company's order inflow for the current quarter reaches around 3,000 crores versus 3,080 crores seen in the last quarter. Now, order book of the company as of Q3 FY26 stands at 12,641 crore with an uptick of nearly about 11% on a YoY basis. Next up is GR Infra. It emerges as a L1 bidder for NHAI project worth 1,454 in Gujarat, and companies also received another order over this weekend worth nearly about 413 crore from NTPC. This is mainly for implementation of battery energy storage systems at its thermal power station. So all in all these two stocks will be on our radar today and expecting green.
All right. Thanks very much, Upasana, for that quick recap of things and stocks that we've put out. So aluminum stocks in focus. Aluminum prices are jumping. Coal India is in focus. Defense, which we highlighted earlier. Urban Company, ONGC, Oberoi Realty, EPL, Thermax, and GR Infra. Stocks on the other side, which are likely to open. There's, of course, banks. And, I mean, a lot of pressure. I think it'll show up everywhere in more ways than one. GIFT Nifty still indicating a sharply lower start.
Okay, all right. Well, let's turn our attention away from equity markets then. Let's go across to Manisha. She's here to tell us what's going on in the commodity markets. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, where we've seen 3% of gains in the Asian markets right now. We are trading above $115 a barrel. Iran war entering its fifth week, and no swift resolution in sight is keeping the prices on the higher side. Houthis also have joined into the war, and then there is Ukraine using long-range strikes on energy infrastructure. So whichever way you see, there is attack on energy infrastructure, and that premium is getting into the prices there. The precious metal prices, though, have continued to decline. Gold is down a percentage point, silver down 2%, and silver actually has gone in for a negative for 2026 till time right now. The copper prices also have continued to decline in the Asian markets right now. Last week was a good one, but metals have continued to underperform since the conflict, barring aluminum, of course, which is trading at around multi-year highs right now. After Alba, it is Aluminum Bahrain and Emirates Global Aluminum as well, reporting significant damage at their facilities, supporting aluminum prices. So when you look at it on your screens, in the metal space, it's only aluminum which is trading positive, and then you have energy. Everything else slightly under pressure.
All right, Manisha, thank you very much for that. We take a break. We are back, and we'll be joined by Dinesh Khara, former chairman of State Bank of India, and Abhizar Devanji of Neostrat Advisors on what the RBI has done. Basically, limiting the amount of positions that banks can take in rupee markets, dollar rupee. A lot of covering expected, strength in the rupee expected on the back of it. So coming up in just a bit. Welcome back. Markets, of course, very, very focused on what's happening with the rupee. The rupee hit almost 95. 94.80, I think, was the low on Friday. After market hours on Friday, after the rupee markets had closed, the RBI came out with a circular capping the total positions that banks can take in the onshore currency market to $100 million. Banks have to implement this by the 10th of April. Sources tell CNBC-TV18 the banks have sought some extension, but I mean, we're already here. It's 8:40, 20 minutes market will open. So unlikely, and RBI is not known to pull back in circulars that it kind of puts out. So this morning, banks will have to sell dollars here and buy dollars overseas. So rupee is expected to strengthen. The gross positions in this arbitrage trade, which banks were indulging in, is estimated to be some $40 billion. And bulk of this exposure, we understand from conversations, are concentrated in about 8 to 10 banks, largely, I mean, public, private, but of course also foreign banks were involved in this. We have Dinesh Khara, former chairman of State Bank of India, and Abhizar Devanji, founder of Neostrat Advisors, who are with us. Gentlemen, good morning. Great to have both of you here. Mr. Khara, Prashant this side, sir, and thank you for joining us. I mean, sir, this was a very profitable sort of venture for banks. I mean, this arb trade. But could you tell us, do the numbers seem very large to you? I mean, $40 billion, I mean, it's a huge number, right? I was told SBI perhaps has got the largest exposure, just by, obviously, the sheer size of it.
Well, when it comes to this kind of a guidelines which has come from RBI, I would say that perhaps it is intended with the intention to ensure that the risk remained contained and it should not go beyond the limits. And with that in mind, the kind of volatility which you're seeing in the currency market essentially attributed to some banks having huge open positions, and they were actually playing on the speculative trends in the market. So I think it is essentially to curb that, because speculative trends generate profits in the short term, but in the long term, it can actually impact the stability of the institution also. So with that in mind, perhaps RBI has come out with these guidelines. And actually, when I looked into this, it was reminded me of the year 2011, when also we had seen similar kind of currency movements. And at that point of time, RBI had put condition that it should not exceed 15% of the capital. So, in fact, then onwards, the boards were given the discretion by RBI to lay down the limits for this kind of a currency trade. But yes, of course, there are certain large banks. There are certain large banks who actually operate on the proprietary book. The intention of the net open position is essentially to ensure that the bank should be in a position to serve their customers well and without really impacting their balance sheet. This is what the intention has always been. So I think when it was being leveraged for the short.
So, Mr. Khara, in a way, in a nutshell for our viewers, right, RBI is saying that we don't want to supply dollars to for the purpose of giving it to hedge funds, right? I mean, we want to use dollars for the real things, which is trade and
absolutely
FBI
that is the intention,
outflows, etc. Right?
Yeah.
So not the speculative side of it, and perfectly, absolutely understandable. Typically, Mr. Khara, in your experience, this would happen, and I was told this, that the RBI would give some time. I mean, they'd basically call up banks and say, well, wind this down. And it won't be, without any warning, not a circular. So that's one thing I heard. Any thoughts?
Well, I think the kind of rupee volatility which we are seeing for last couple of days, almost a month now, was essentially perhaps the reason why maybe the moral suasion was something which should not have worked. That is the reason why RBI has come out with such kind of a step. And they've done it in the past also. Sometime in 2011 also, as I mentioned, this kind of a step was taken. And but yes, of course, they very closely monitor the orderly movement in the markets. And I think it's moral suasion and then followed by that seems to be the...
But this time looks like moral suasion. Maybe events overtook them, right? I mean, the fall was so
also
sharp.
Actually,
we're all wiser in hindsight, but no one really saw all of this coming together and happening together in that sense.
Absolutely.
Mr. Khara, now, how will banks book this? There will be a loss which will have to be booked. There are some estimates for $500 million.
They will have to go for the MTM because $500 million limit, if at all, some banks are holding that kind of a limit. They'll have to pare it down to 100 million. And 100 million has to be done by 10th of April as per the guidelines. So I think what will happen is that slowly and gradually they will unwind their position. And my expectation is that almost about 18 billion odd would be the amount which should be available for unwinding. And I think perhaps it will lead to almost about 100 paisa strengthening of the rupee. This is what my expectation is.
Sorry, it's not. You're saying it's not 40. Your estimate is it is about $18 billion, 1/8.
Yeah, my estimation is about 18 billion.
Okay, that's important. We should put it out. So not 40, but 18. That is your estimation. You're saying about a 1 rupee strength in the rupee, Mr. Khara.
Yeah, this is what my expectation is.
Mr. Khara, so when you were the MD of State Bank of India, was the net open position by the bank, do you think similar or the industry similar to $18 billion? Or do you think it's gone up now in the recent past?
No, it would have gone up. It would have gone up. Actually, many of the foreign banks are very active in this particular space. And so I think my sense is that, in fact, when we were approving the limits within at the board level, we were very mindful that we were never having intention of the speculative gains. Intention was more in terms of ensuring that we should be in a position to meet the customers' requirements. So that was the kind of, and also those were the days when the volatility was not at swell. I think now it has gone up significantly. I would say that in about a month's time, rupee has depreciated almost about 4%. It's a very significant number. Normally, we had seen about 4% depreciation in a year, but now it has gone up almost. I mean, we have seen rupee depreciation of 4% in a month. So that is, I think, that needs to be curbed. And with that in mind, this kind of a section has been issued by RBI.
Okay, all right. Let's get in Abhisar Divanshi as well into the conversation. Hi, Abhisar. Good morning. Thanks a lot for joining in on the call. What do you make of RBI's move? As Mr. Khara says, that the depreciation has been very, very sharp. And if I look at it in this fiscal itself, the currency depreciation has been close to 10%, which is the highest we've seen in more than 10 years. What do you make of the move that the RBI has done? And have you done any rough math in terms of the open positions?
Yeah, so yes, I mean, a little bit. I'd agree with Mr. Khara that it's around 18-20 billion of open positions, most of it large Indian or foreign banks, because none of the other boards would have approved limits which are significantly large. But, just dissect the situation. First of all, this circular says this is only for net open positions onshore. Now, that's very important to understand, because banks may not have necessarily taken net open positions overall, because what they would do is they would short in the domestic market speculatively, but cover in the NDF market, which is the non-deliverable forward, which is a market that exists for Indian rupee dollar overseas to be settled in dollars. So ideally, the bank's net open positions overall may have been under control, but onshore would have been exceeded. Now, why onshore would have been exceeded? Because of the systemic dollar flows, outflows that are happening in India, be it stock market, be it importers, be it whatever, because of the rising oil bill or the falling stock markets, or all those things. There is pressure on but the bank speculated domestically because of the actual flows. Yeah.
So, sorry. We lost you there in between. Yeah, go on, Abhisar.
Sorry. So because of the actual flows, what you would do is would withdraw, you would try and do short positions domestically and try and cover them in the NDF market. So banks, NTMs are not impacted because these are kind of ready forward transactions. But what really happens is now, when you have to regulatorily bring the position down to $100 billion, there will be a contraction of the gap in the NDF market and the rupee market.
Yeah.
Plus, domestically, because you'll have to cover positions, the domestic rupee, as Mr. Khara also said, will improve significantly. So as a result of this movement, because of regulatory intervention, banks will have to book a loss.
Yeah, no, absolutely. Well explained, Abhisar. We have you on a slightly scratchy line. Mr. Khara, after today's 1 rupee appreciation, you think it'll hold? So say it goes to about 93.50 dollar rupee this morning. You think it'll hold for some time there?
My sense is that if the speculative players are not all that active, and also the trend as far as inflows of dollar continues, then I mean it has to be essentially a balance between the inflow and outflow. So I think in the current scenario, my sense is that it should help in holding it around the same levels.
Got that. Mr. Khara, thank you for joining us. I know you're outside and there's activity behind you, but appreciate you taking out the time and being with us. Abhisar, thank you very much. Appreciate your time here on CNBC-TV18 as well. We'll take a break. We're back and we'll come back with Dharmesh Kant of Chola with some stock-specific questions and just leaving you with the GIFT Nifty to see if there is any change. Dow futures, I think, have recovered a little bit from the lows. Stay tuned.
Welcome back. Hope you're having a good morning and a good start to the week. For markets, though, we're going to be a little bit jittery to kickstart trade. That said, a good time to welcome Dharmesh Kant, Head of Research at Chola Securities, who joins us on the show. Hi, Dharmesh. Good morning. Good to see you, Ben. Looks like you're part of the good news because the GIFT Nifty was suggesting 280, 290 point downtake. I think that's cut its losses. And the US futures have moved into the green. It's going to be a tricky trading session. But a sector that could do well is the aluminium players. We know the Middle East capacities have been getting shut down. We saw what happened in Bahrain. We saw what happened in Qatar as well. And over the weekend, we had another facility that did get hit. How would you approach these players? Stocks like Vedanta, Nalco, as well as Hindalco, they're a good run, and then they pull back considerably. Your view?
Yeah, good morning, Nigel. Thanks for having me for the show. Hope so that today is a good day. It's been a monthly expiry and a lot of pain has been there in the market. So some short covering rally can stabilize the market. To my mind, 22,500 valuation-wise also looks pretty attractive, and more of the damage has already been done. Even if you take a flat Nifty EPS of say 1,200 for FY27, then also you are 18, 19 times 1 year forward PE multiple, which is -1 standard deviation to the long-term average. So I think that provides you the cushion and comfort that downsides may be restricted. In that space, as you have rightly pointed out, aluminum looks attractive. This is the only metal along with tin for the year, which has gained around 9% year till date, and volume traction has also been. Only the caveat is China is sitting on inventory surplus of aluminum. So if that supply comes into the market, whichever route it comes through, may have some liquidating impact. As of now, it's not been the case. Vedanta as well as Hindalco has corrected, sharply from their highs, and we have been bullish on the metal space for quite some time. And any corrections out there, we have been recommending our clients to get a hold of it and to invest incrementally, though not all in, but in a staggered space. To that extent, both looks pretty good for us from an investment basis. We have been avoiding Nalco though. So Hindalco, as it offers a diversified play, along with Vedanta, where again our diversified play is being offered at. Both valuations have now near the mean multiple, so 10-15% upside rally on a good day is expected from there. So a good investment bet, definitely.
Good investment bet. Dharmesh, we'll start with the earnings preview soon. So at Chola, you all must have prepared that. So can you tell us in Q4 which companies are likely to see the highest earnings downgrades on the back of the war, the increase in the inflationary pressures, etc.?
Yeah, good morning, Rima. The biggest suspect in Q4, having regard to how the things are going to roll out in Q1 FY27, will be the NBFC and banking space all put together. Private sector banks, public sector banks, and the NBFCs are the suspect out there. Other than that, I think everything will deliver the numbers in line with what the expectation has been. And Q4, we have been going with around 4 to 5% kind of a growth, because last year Q4 was far higher. Nifty EPS was itself 327 to 328 rupees. So you are already approaching this Q4 on a high base. So IT will be a flattish kind of scenario. Pharma, again, in line with around 15-20%. In that range kind of a growth should be there. Chemicals should also do well. Metals, again, would be delivering good set of numbers. Automobiles, the best of the lot will come from the automobile space. As far as the numbers are concerned, we are building in 17% kind of a aggregate sector growth for automobiles. But since financials control 38% of the entire, Nifty earnings aggregate, so that is where we are suspecting some damage. One is because of higher bond yields will have a corresponding impact on held for trading treasury. So there will be some impact out there. Other incomes would be lower. And maybe because of some minor, provisioning being advanced for your MSME and small scale and retail side trade. So because of the situations which we are seeing on the ground level, and trade growth is likely to be tapered going forward. So this is a space which looks vulnerable to us.
Okay, all right, Dharmesh, thanks a lot for joining in. A short but effective chat. Appreciate you joining in and giving us your views. We'll catch up during the course of this week. Well, for the time being, I'll tell you what, we'll slip into a short break, I think. We'll come back. We'll get you our technical experts. We'll also get the initial rates of the rupee. Jayesh Mehta, DSP Finance, will be joining in to help us out with a quick analysis on that one.
All right. I think there's a minute to go for the, not minute, a few. Let's just quickly have the rupee up first, please. Rupee is open. There you go. That's what I'm talking about. Dollar rupee, 1.25% higher on the dollar rupee. You know, 93.58. Basically, the rupee is stronger and the dollar is weaker, as was expected. It's a full 120 paise appreciation on the Indian currency. So this is what we're talking about. We should actually have this up at the bottom of this. Yeah, have this up at the bottom of the screen. I think this would be one of the largest appreciation moves in the recent past. And this is coming in a very, very sharp way. So we'll just stick with the dollar rupee rates here. I think 1 month forward rupee in the NDF market, we're getting rates as well. Expect a large difference between the onshore rate and the NDF rate as well. And I think we are, yeah, so that is 94.45 in the NDF market. And this is 93.66 or so at this point in time. So banks would basically sell dollars here and cover their short positions in the NDF market by buying dollars. So forced reversal of trades because of what the Reserve Bank of India put out as a circular on Friday evening. And we'll have Jayesh Mehta joining us on this in just a bit, but maybe just quickly, if we can run through the trading ideas, maybe hitting all things a little later because of the volume of news flow. Sudarshan Sukhani is with us and Shrikant Chauhan is joining us today. Gentlemen, good morning. Good to have both of you here. Sudarshan, so on the Nifty, I think from the time we started at 8 o'clock, there's already a 100-point lift in the GIFT Nifty because of US futures jumping up a little bit. But what's the setup and how would you trade it?
Yeah, good morning. The setup is, let's look at the GIFT Nifty. It went down to touch and then test the lows that we have made earlier in the Nifty. That was 22,450 approximately. So while the GIFT Nifty is not really representative, there is a sense that the lows were touched, tested, and then there was a bounce. So as far as today is concerned, we are looking at to buy the Nifty with a stop at 22,450. Now, the exact entry point will have to be different depending on how the market opens. But the buying theme persists. Then we have year-end expiry, then monthly expiry. So today should be a day to buy with a very clear stop loss.
Okay, buy today with the Nifty headed towards 23,450. Is that the target, Sudarshan?
No, the stop loss is 22,450. I don't.
All right, okay. But buy is the call right now. Shrikant, what would you go with?
Good morning, Rima. Good morning, Prashant and everyone. So for Nifty, it is showing a lot of weakness. It closed below the mark of 23,000. It is forming lower top, lower bottom series. So all these things indicates that market is going to remain under pressure. And it is better to stay away from taking any specific view on Nifty. It is better to be more on the stock specific side because it's a quarter end and yearly closing, also financial year closing. So we may see some stock specific action in the market. But for the Nifty, we are of the view that now it is heading maybe below the levels of 22,500 in the near term. So at higher levels, we need to be very, very careful in case if there is any bounce back because of this particular news flow, we should look for reducing some long positions.
Trades, Shrikant? Stock trades?
Yeah, so I think, because of this particular developments, we can expect, and the news flow which are there in the market, we can expect some activity in sugar stocks. So in that, we like Dhampur Sugar, Balrampur Chini. From the defense space, we like Bharat Electronics because there is specific news flow on the defense side. Bharat Electronics was around 470. From there, all the way it is at 400. So from here, entry looks quite, the current prices looks quite reasonable to enter into long positions with a stop loss close to 390 on the downside. We like Balrampur Chini on that already. I said that it is maybe heading for the levels of 550, 560 for sustainable run up. And we can keep stop loss around 480 for creating any trading long positions. But for shorting, I think bank stocks looks weak. There we can expect further more weakness. And in that, IndusInd Bank looks weak. Currently around it is 790. 800 sort of levels, but the stock can fall to 750 sort of levels.
Yeah. Sudarshan, what about your trades?
Well, Federal Bank is a buy with a stop under 265. Lupin is a buying opportunity with a stop under 2290. Ashok Leyland is a short with a stop above 165. And Bharat Dynamics, BDL, is a short above with a stop above 1155. All these levels will have to be adjusted depending on how the markets open. But broadly, they should hold.
Okay, thanks very much, and we'll chat again. Thank you for joining us, Sudarshan and Shrikant. Jayesh Mehta, Vice Chairman and CEO at DSP Finance, is with us. Jayesh bhai, good morning. So there's a 1% appreciation in the rupee, as I think was expected. Now the question is, will this hold? Will rupee at whatever 93.60 or so? Is that the new normal, or what's your sense?
We still have other outflows, but at least what this will do is make RBI intervention quite effective, because what was happening because of this arbitrage allowed between onshore and offshore, a lot of intervention apart from the normal trade, normal FPI outflows and all of that, it was also going to the offshore traders, right? So from that perspective, that bridge would be broken, which is required in this kind of situation because we are still not a convertible currency.
And it is, as we are flashing, the difference between the onshore rate and the offshore rate is quite large now. That is to be expected, right?
Yeah, it went up to 1 rupee difference. It came down, I think, now around maybe 80 or so. But yeah, it will pan out over the next few days. But yeah, that would remain wider. Maybe eventually, just like before this was allowed, it was like 40, 50 paisa or something like that. That kind of difference would remain going forward. But at least this unwinding, we don't know how it pans out. But the fear market had like it would go to 1.5% or 2 rupees or something like that. That's not happened, which is good actually for people to unwind if they have.
Okay. What would be the overall unwind which is required right now, Mr. Mehta?
They have been given time till 10th of April. Of course, there is a lot of representation to let it expire and all that. We don't know what RBI does, but at the same time, from today to 10th, whatever long they are onshore, they will have to sell it, and whatever short they are offshore, they will have to cover it, or let if there is an expiry coming in between or something.
Mr. Mehta, that's on the timing bit, which is a little unclear because the RBI has asked for some relief. But in terms of the net open positions right now, how much needs to be unwound?
Everybody's guess. The market is guessing from 20 to 40 billion dollars, and then the safer way is to take 30 billion, because I don't think these are all confidential data. So people really don't know, but this is just guesstimate of the people. Okay. So that's what people are taking soft at 30 billion or so.
Okay, and do you think the reprieve that we're seeing today is temporary?
No, the relief? Again, I think that unwinding will happen, then onshore will dealing 2 by 50 paisa. And then, of course, whatever happens to oil, war, we are not out of woods, right? But at least the intervention by RBI will be more effective.
Jayesh bhai, on this circular came on Friday evening, right? Offshore was still trading. So the people would have covered that leg, no? On Friday, somewhat, depending on how much liquidity is available.
Yeah, because it's late 8, and again only US open and stuff like that. Some people did cover, but I think it was not dramatically much, and it was not even known. So it was like 40-50 paisa, it widened to 40-50 paisa. So that kind of thing, some people were able to cover to 40 to 60. It went up, and then of course today morning it went to 1 rupee 20 paisa or so. Now down to below 1 rupee onshore offshore. I don't know what it is exactly right now, but yeah, it is moving continuously by the situation.
So the cost of hedging also goes up now on account of this volatility. What are the implications of that?
Sorry?
The cost of hedging would also go up, right? Now because of the volatility?
I can't hear you.
All right.
Sorry.
Okay, we'll...
I think we'll come back. Jayesh bhai, thank you very much. Appreciate it. You, of course, ran operations at BOFA for a long time, and you've seen much of this over the last 30 years or so. So good to get this perspective. I think, what we can do is we can move on to our next set of guests. And 4 minutes out, by the way, for market open. The pre-open is settled. Let's just look at the rates quickly. The Nifty, it's down about, 260 odd points, 270 points right now. 550. 22,550 on the index at this point in time. The dollar rupee is also settling down. I think it had a bit of an overshoot right at open at 9, but now 93.94 is where we are at. Well, we have the top team at UBS right here with us in the studios. Gautam Chachoria is head of global markets at UBS. Tanvi Gupta Jain is chief India economist. And Divya Nagarajan is head of India research at UBS India. Gentlemen and ladies, thank you very much for joining us. Really appreciate your time here. And good that you guys could make it here in the studios. Tanvi, the rupee, I think, what's your view, Tanvi? I mean, lots of reactions. We had Mr. Khara, former with SBI, and we had Jayesh Bhai and Abhizar, etc. So the point that he made is, Jayesh Bhai made towards the end, is that this makes RBI intervention in Forex markets because it'll be required, much more effective. The money, the dollars are not going to the hedge funds anymore, but to finance trade and real stuff. So just your thoughts.
Absolutely. I think the INR remains the biggest focus right now. I mean, we did see on Friday the measures being announced by the RBI, but we think it is a very temporary respite to INR. We still have for the June quarter, INR view is still 95, so we are not expecting any sharp appreciation from here. Whatever you are seeing today, some currency appreciation or some support to currency, it's very, very temporary. What we realize is the biggest challenge from an INR perspective is not only the level of current account deficit, but the funding concerns. And I don't see any quick respite on that. I mean, we are seeing FII outflows has been quite significant. FII debt has been muted, and overall FDI flows are not enough, especially the net number is definitely not enough. So we might be staring at one and a more year of a balance of payment deficit. I think what we realize is that when we compare, and a lot of investors I'm talking to are comparing it with the 2013 taper tantrum, but the difference this time around is that RBI has still a lot of policy steps that they can do to ensure that a free fall in INR could be contained. For example, if I look at past, I mean, we can announce a bilateral swap window for the oil importers. That could be one step. Maybe some curve on gold, maybe some view about raising NRI deposits. So I think there are ways to manage the currency weakness. But near term, I think the entire focus is on de-escalation, if at all. That can even be hoped for. But otherwise, we think that the depreciation pressure on INR is likely to stay.
Let me just get a quick read-through from all of you. Divya, if I can ask you, across companies that you speak with, right, how severe is the disruption on a scale of 1 to 10?
It's right now still a question of where supply of natural gas is being impacted. So you would have seen where there's a cluster which is dependent on that, that's gone down, or utilization has dropped in things like fertilizers. But across sectors, I think it's still very early. I think there are fears being priced in, but are we seeing anything on the ground yet? I think it's a little too early to see that.
Okay, all right. Just taking note of market open, and then we'll get Gautam into the discussion as well. First rates are coming through. And it is 22,590 on the Nifty, 51,474 on the Nifty Bank, and more rates will come up on your screen. What do we have? The mid-cap index is down 1 1/4, about 700 points lower. The small-cap index will come up. That's also should be down on similar lines, about 1.5% down. 1.8 actually on the small-cap index. So 340 odd lower on the Nifty, 22,490. Let's look at the Nifty heat map, how are things opening right to the word go, and then we will look at individual names as always. I think bulk of everything should be in the red, and the heat map will give us a quick sense of that. Many Nifty names are at the bottom of the screen: Shriram Finance, Interglobe, L&T, etc. If you can have there you go. Hindalco is up, so there's a bit of a lift on aluminum prices because of the disruption in the Middle East and one of the facilities. ONGC is up a little bit, but otherwise 48 out of the 50 names are starting in the red in varying degrees. Rima.
Well, the low today in the morning was 22,472, which exactly coincides with a recent low of 22,471. But we're still hovering precariously close to that level. It's now 22,500, straight away down more than 1% at opening levels. Today is also the March monthly expiry, and it's also the year end, so you could have some amount of NAV propping that comes into play. Well, now some more gainers have been added in, so it's Hindalco right on top. Let me start with the gainers list, fewer. Hindalco is up 2%, but buying is visible in NTPC, Coal India and ONGC. So 4 PSU stocks in the green. On the way down, Banks are getting hit very hard. The Nifty banking index is opened with a downtick of 1,300 points, 2.5% lower. Axis Bank, Kotak Mahindra Bank lower by 3.5%. HDFC Bank is down 2%. There was an upgrade on HDFC Bank by JP Morgan. They upgraded it to an overweight with a target price of 1,010. They're saying the bank's valuation is at 1.5 times price to book. If you look at the parent company for FY28, following the correction, and it's underperformed the peer. So the discount versus ICICI Bank is also at the highest ever level, but that's still under pressure. So banks are getting hit.
One thing, HDFC Bank, from what I remember, right? I mean, their activity or participation in this kind of things is very low. I mean, out of the private sector banks, they'll be very, very low. ICICI would be higher, others would be IndusInd, etc. were higher at one point. So I don't know if this is HDFC Bank is under pressure because of this, but just in terms of sheer exposure, should not be that much.
Okay, so that's about banks. So banks are getting hit hard. Autos, that's the other sector under pressure. You've got Tata Motors as the top loser, 4.5% down. NBFCs like Shriram and Bajaj Finance are weak in trade. Trend consumption has not been spared. So Tata Consumer, Eternal, Trent, weak in trade. And pull up some of these IT names. IT is opened up in the red, but the gashes are not as deep. So we've got about 1.5% downtick for TCS.
Well, Rima, today's low and last week's low is actually pat on, 22,470. That's the low that we made last Monday, and we saw a bit of recovery from there. Today, the cues are very different, but the hope is at least we hold on to that level. The India VIX, that's the one that's perked up. Remember, last week it cooled down all the way to around 20. That's on the verge of actually moving to around 29 odd, and that's not a great sign from an equity market perspective. You want the India VIX to cool off. Very few winners, but let's highlight a few. KNR Constructions, they have won 1,700 crore. NHAI road project in Telangana. So that's one stock, in fact, that's bucking the trend today. Nalco, that one's well placed because aluminium seems to be in a bit of a short supply globally. The Middle East accounts for around 9% of the total global supply, and they're bulk exporters. So because of that, supply in the global markets could go down. And for Nalco, they don't get hit by higher power costs because they get most of their coal from captive sources. So that's why that's outperforming Hindalco as well as Vedanta. The core aluminium play, stock up close to around 4%. EPL is another stock that's up close to around 3%. They've announced a merger with Indorama-backed Indovidia. So that's why that stock as well is higher in today's trading session. Very, very few winners, but those are a few of them that I could get on the list. Tata Motors CV, there was a rebalance that took place in Friday's trading session, the final 30 minutes. So that's giving back what it put on. Grow is coming for some profit taking, falling on rather large volumes. That's down close to around 4%. And you have Axis as well as South Indian Bank, both of them under some pressure. Only 400 stocks are advancing. Hopefully, by the time we end up, that number will be higher than where we start off with.
Okay, all right. So that's the market open for you. And this is lower as expected. So Tanvi, of course, is with us, and Divya is with us, and Gautam is with us. This is the top UBS India team. So Tanvi, Divya was just telling us that the impact right now is being priced in, but actually in terms of industries being disrupted because of shortages, it's not, I mean, it's not widespread, Divya. That's what you're saying, right?
Yes, it's too early to assess the extent of damage. And I think, as Tanvi mentioned earlier, it's a question of how long we take to de-escalate. Because the
Just
longer we do that, I think the longer
the perceived, I mean, all that becomes real in that sense. Gautam, your thoughts? Just top of the mind, top-down kind of thoughts on what's happening, and how is this likely to play out from a impact perspective?
So again, duration of disruption is the critical missing piece, which none of us are experts to make a call on at this stage. But the only hope which many of us and in the markets derive is that one of the common consistent comments coming from the US administration has been that we will not repeat earlier situations of a prolonged presence of war. Now, whether they stick to that or not, we don't know. The second point on that is the definition of prolonged. The kind of situation we are in, even a 3-month to 6-month issue could be quite damaging, both for global growth inflation as well as for India. So the timelines are very different. Like we're not talking about years, even months is going to be bad. Okay? So you have to keep these things in mind, and therefore the way we'll put it is talking to investors, the tail risks of this being prolonged for months is still not priced in. And there are asset classes, or even in the Indian context, rupee is one which we mentioned, where this could show up much more clearly. So even though the rupee has moved, the tail risks are still there around the currency. Okay. The Indian markets, look, to some extent, the local flows are helping very clearly. But look, the retail is also kind of at the stage where their books are not necessarily looking attractive, and they start seeing red. and how they behave is still early. They have been quite mature. So the answer is duration, like how long this lasts. At levels wise, this is a level where India bounced back from last year. On a headline valuation basis, this is where in the last 10 years, Indian markets have largely bottomed out on a forward valuation basis. But again, just to put things in context, before 10 years, if you go back to the taper tantrum era or even before that, these are the levels where market used to peak at. So the paradigm also changed because of the local retail flows. But this is an interesting level. And we are seeing some investors, a very small minority of investors, willing to take contrarian bets also. Contrarian bets, not just defensive bets, but contrarian bets, but very small. So again, it will be news flow driven, if I have to just let it out like that. The way every overnight situation develops, that's how markets will react. For long-term investors, some would start dipping in here, absolutely.
But Divya, on the E of PE, right? Gautam was just talking about the valuations. Interesting. But the E of PE is also going to get compressed on account of the inflationary shock, etc. Or Gautam, if you want to come in on this, are valuations really cheap, according to you?
So again, if I just add in, like E will get hit. And depending on the duration, the E hit can be meaningful. But the question is the base case earnings capability of the Indian economy and corporates. Does that get hit longer term or does it a one-time hit? So if it's just supply chain driven hits, it'll come back fairly fast. If it leads to oil remaining higher, so the key debate is oil, where does it settle after this disruption? If oil remains at 100, 120 for a prolonged period, then E will also get damaged for a longer period. So that's the simple way to put it.
But Divya, what's the extent of the earnings cut that you see in the base case and perhaps a bear case?
So I think, again, it's going to be very sector-specific, very company-specific. The way I would characterize the situation is that pre this conflict, we were at a position where it looked like growth had bottomed, and inflation had bottomed as well. And we were therefore looking at a possible early cycle recovery for the country and for the markets. Now, the real question here is that, as Gautam said, there is going to be an earnings hit. But at this point, I think we have three scenarios, right? The first scenario is that it de-escalates this week.
Hopefully.
The first scenario, yeah. The second scenario is that it takes a couple of months. The third scenario is that it goes on longer. In each scenario, the oil price impact gets asymmetrically higher. The impact on global GDP and inflation gets asymmetrically upfront. So the base case scenario, we're probably looking at a 50 basis points or 60 basis points global inflation risk. But at 150 to the oil, it becomes 190 bips. So the longer, and I think to go back to Gautam's point, we could put out a number now, but the number would essentially be dependent on how quickly this de-escalation happens, because the risk is asymmetric on the downside.
Okay, all right. I hope if Mr. Trump has to say something, he does it during the course of the day itself rather than wait till post 3:30 p.m. like we saw last Monday. That said, Tanvi, let me come to you then. What are you penciling in? You told us that the rupee, you're penciling around 95 odd. How much have you scaled back your growth estimates because what has taken place? What about the deficit number? Sure. How much has it widened in comparison to what you were working with earlier? And the RBI, do you think that rate cut hope is now out of the way? Do you think at some point of time we say a rate hike?
Okay. So very valid. So we have still not revised our GDP growth assumptions downwards because we're still working on scenarios, as Divya mentioned, 5-week, 2-month, or an extended oil disruption scenario. But I can give you the numbers. We are right now at 7% real GDP growth forecast based on oil at $75 a barrel. Oil at $100 a barrel, which basically means a 2-month disruption. My GDP growth is 6.3%.
So 70 basis points.
Yes. Okay. And oil remaining at more than $120 a barrel for an extended period, GDP can go even as low as 5.5%. Okay. So that is the asymmetric impact we are going to see on the growth. On inflation, versus our 4.3% in our base case, we are seeing inflation then clearly cross 5% depending upon the extent of pass-through. I mean, we have been seeing that the government has cut the excise duty on gasoline and diesel, so basically have shielded the consumers so far, but if the disruptions are going to last longer, I'm definitely expecting some partial pass-through to retail prices post elections. 9th of April, when the 2 state elections get over, in between, I would expect some partial pass-through to retail prices for households. And the third is what it means from an overall macro perspective and the current account deficit perspective. So far, we have not really seen demand destruction directly. Yes, there is outside of direct price pass-through where we are seeing that even in the informal market, the prices have gone up, the cost of production is going up, gas shortages is very acute, companies are facing, limited supply, the supply chain capacity is getting affected. But if that situation is going to last longer, I think we really need to see what RBI can do. And I think the biggest challenge what we started during this conversation is current account deficit and external financing from an RBI perspective. Even if inflation goes up, and the starting point of inflation this time is very low. We are staring at a number, maybe 3% inflation, and the current monthly number goes back to 5.5, which is okay. I mean, we are somewhere between 4 plus 2% as the inflation band on the upper hand. But I think the biggest concern is the funding of your current account deficit. And just to give you some numbers, when 2013 taper tantrum happened, we were a much smaller economy. You raise NRI deposit, you do some import curbs, you were fine. You were able to stabilize your currency. Right now, even before the oil shock happened, we were staring at a current account deficit of $60 billion. And with this oil remaining at $100 or more, it can clearly double. At least more than $100 billion could be your current account deficit. So either I'm able to do some demand destruction so that my non-oil, non-gold import can get curbed, or I need to figure out ways to fund this current account deficit if the situation is going to last longer. So in terms of numbers, current account deficit in my base case is 1.5. That can clearly go well above 3% of GDP, depending upon the extent of duration of this overall oil disruption.
And the point is that the rupee, when we talk about the rupee hit, etc., right? I mean, I think a lot of Asian countries have surpluses, right? I think at one point, two months back, I think everybody had a surplus. Some of these countries, because of whatever, chip exports and things like that, North Asia. So in that context, I mean, the rupee gets hit. I mean, it all kind of sort of ties in. It's all relative, and maybe that's the reason why we've had a bit of a hit here.
So let me add to this. It's always relative, and we have seen INA underperforming even last year, right? Because we have a forward book which is already at $100 billion. So when you see the headline FX reserves number of more than $700 billion, and we say we have 11 months of import coverage, ideally you should adjust it with the forward book and even adjust it with gold. And then you will say that we are staring at a FX import coverage ratio of maybe 8.5 months.
We do typically adjust it for gold, ex-gold also, but why should we do it?
I mean, ideally we should not, because we can always use gold to fund our, current capital account. But I'm just saying, on a foreign currency asset basis, adjusting for a forward book, you're still at 8.5, 9 months of import coverage. Market seems to be pricing in, at least the OI's curve is pricing in 4 rate hikes by the RBI in the next 2 years. It is not next 12 months. I think I would say the bar of a rate hike at this point is pretty high, because we still have a lot of tools available by the policymakers in trying to prevent, and try to support growth and try to prevent a very sharp weakness in the currency. I mean, RBI policy is now overdue. So let's see how the RBI is going to look at things.
Okay, all right. Gautam, let me get you back into the conversation. That you mentioned a small portion of the investors you interact with, they want to do the contrary thing. That is, go ahead and, dip into the Indian markets. We didn't party big time on the upside. Indian markets underperformed. Do you think, going by the valuations that have come down a little bit, we went through a period of underperformance. FIs are underweight the Indian markets as well, relatively. Do you think Indian markets at least could outperform from here on, or you believe that, we continue to underperform?
Look, firstly, our EM strategist has been underweight, still remains underweight.
Okay.
So that's our official published view from a research perspective. Talking to investors, I don't see any early signs from global investors that they will look at India as a contrarian trade. Still very early days. So when I say contrarian stock picking, it's more from the domestic investors, less from the global investors. For India to outperform, I think one of the key ingredients beyond the situation or the war in Middle East would be currency. Okay. And currency, look, the worst possible things which can hit Indian currency happen all together. Not just last 1 year, but even last 3 months. And even if 1 or 2 things change, currency could change very fast. Like, it's a very consensus view right now, rupee will keep on depreciating. But if any of these things change, that will get possibly the FPIs to come in as a tactical trade. From a more fundamental perspective, the things which were constraining India, which were relatively slower growth and rich valuations, absolute and relative, they still hold true. I don't think that's changed enough for them to come back in a hurry and be overweight India. Still early days.
Okay.
Just to add on to that perspective, I think the reason we've been underweight from an emerging market perspective on India is that what's been driving in emerging markets is essentially the US AI trades, which India has lacked. So at this point, I think our current view is that we don't see at this point this situation still risking the US AI trade. So as long as that view holds, I think that's the reason that the emerging market view is underweight.
9:50, we've got a discussion, guys, coming up with Saurabh Mukherjea, who's written a book. It's called The Crisis of the Middle Class and the Future of Work. And it kind of sort of ties in with that lack of AI or whatever you want to call it, right? I mean, but in India, I think it's been debated quite a bit. But Saurabh's looking at it from a different point of view, which is, I mean, what's going to do to jobs, purchasing power, spending, consumption, etc., etc. So those are kind of longer-term issues, right? Which you
Yes,
got to...
indeed. And I think for IT services, which is a large part of the index in the market, I think that's a very pertinent question. Or IT services analyst Aditya Chandrasekhar, he just put out a very interesting, what we believe will be a lead indicator kind of a framework, which he calls Vector. So this basically looks at multiple parameters. Key outcome would be the revenue per employee, so to speak. And hopefully this gives us a lead indication of how companies are preparing for this onslaught. There are two scenarios here, right? On both extremes. One extreme, you could go to a scenario where, like the cloud, companies adjust and then come back to good growth. The other scenario is that everything goes south. It's true, again, the technology itself is in infancy, too early to tell, but we believe that our vector framework, as Aditya puts it out, could be a good leading indicator to track how this plays out.
Yeah, you looked at IT very closely before Aditya took over. You want to tell us which side you're leaning?
It's too early to tell. All I can say is that this technology is advancing by leaps and bounds. I like to say that Salesforce was incubated in 1998, right? It took us till 2015 for us to start seeing impact on a real-world basis from a B2B perspective. Today, I think the pace at which AI and generative AI has been adopted is much, much faster. But beyond that, like I would say, every technology goes through a hype cycle, and we are in early stages of that hype cycle for some parts of generative AI. But I think the technology does hold a lot of promise.
But do you think that the Indian markets have reacted too much to being, missing out on AI? They pull back too much. Do you think it got a little bit excessive?
Well, I think the pullback, and I think Gautam and Tanvi can add to it, is more a function of the fact that it was a PE versus earnings story that really didn't match us, right? I think it's more in the last 6 to 8 months when the AI trade came back. And I think, again, when I talked about the early cycle, Bhanu Bhaveja, our global strategist, was here, I think, last week. And he spoke about how the entire US market was also in an early cycle play, right? So we were seeing money flow into emerging markets. And a lot of that went into AI trades. So I think we did miss out from that perspective. But I would say a lot of what's happened with India in the last 18 months has been the fact that earnings and PE have been a little bit out of sync with each other.
So Gautam, since UBS downgraded India to a neutral very recently, and this came after 18 months of a time correction and 15% correction from the top in terms of pricing. What should Indian investors expect from the Indian market, say, till the end of 2026 or 2 years down the line?
So look, from the downgrade possibly is a different part of UBS than what we represent.
Correct.
But having said that, from investors' perspective, the key as this Middle East thing, the expectation was that things were bottoming out. Growth was picking up, inflation was under control, valuations are gradually getting more reasonable, at least in terms of time correction and versus relative recent history. So those things were in place. But look, this whatever has happened in the last 3 months has changed that discourse. So it's tough to make a 3-year view right now. The tail risk of this being a prolonged war thing, I think that scenario will come back in a year from now. I don't know if it'll come back in 6 months or not, but in a year from now, all the building blocks for things to bottom out should be back. Okay? But if this prolongs, then all bets are off.
But even based on a 5-week impact so far, do you think the lingering impact on the economy will last for 1 year till the end of this year, which means basically it's hard to see any kind of return for this year?
It's just 5 weeks. Unlikely. They'll get normalized very, very fast. So again, question is, in this scenario, we're talking in terms of weeks and months, not years. Okay? Even a few months is going to be damaging. Till now, whatever has happened can be course corrected fairly. Because 5 weeks or even say 2, 3, 4 weeks for the global economy, for India also, there's been enough, we're still living off enough inventory in this system, okay, which we're preventing enough damage in the immediate term. But at some stage, the inventories run off and then the real damage starts. And then how much of an impact is, then we have to analyze how much capacity is off the system because of damage to the capacities in the Middle East. There's no real authentic analysis done till now.
Well, you know, we've all become closet geopolitical analysts, right? Absolutely. So let me ask you, let me do a straw poll. Gautam, 5 weeks, 10 weeks, longer? What's your...
I
5 to galat ho gaya. 10, 15 longer.
I would draw my hope from the consistent statement coming from the administration that they will not be here for long. But again, tough to predict.
Keep the faith, yeah. Tanvi?
I would hope April end, we start seeing some good news.
Divya?
Like I said, I'm not a geopolitical strategist and I can't claim to understand the powers that be and how they think, but I would also hope for an early resolution. I think at least hopefully the second scenario that we have rather than the worst case.
Yeah.
So April, was what I'd hope for.
In terms of published stocks across your coverage universe, Divya, are there stocks already at, irrespective of how long this goes on, actually not irrespective, maybe that's the wrong way to put it, but are there things to do, enough things to do?
So I would say tech is the obvious place where valuations have corrected to pre-COVID levels. One would be very optimistic on the near-term earnings because of currency. However, I think investors are very, very worried about what AI does to the sector. So I think the real question will be that even if earnings in the near-term surprise, which they have in the last 2 quarters, will it be enough? But it's on a valuation basis cheap. The other place is banks, as we discussed, but banks, I think, have some near-term challenges to overcome. But again, valuations, especially the large private sector banks, are cheap relative to their past averages. But I think there are pockets. I would argue that if we had not seen this conflict play out, we were in an early cycle kind of a scenario where some of the mid-caps could have looked very interesting. But I think at this point, we'll have to wait and see how that plays out. So if we are in an optimistic scenario where this quickly goes away, then the cyclicals could come back. I think our industrials team was talking about short cycle plays, actually, where the cycle ordering cycle was starting to show some revival. That could come back. But I think at this point, everybody's waiting before they jump in with both feet.
Well, I think we'll leave it there. Thank you very much for dropping by, all three of you, Divya, Tanvi and Gautam. Appreciate it very much here on CNBC-TV18. Well, I think that is the view coming in from the top team at UBS with perspective across a range of subjects, and we'll get you more of this as we go along. Thanks, guys, for joining us. We'll take a break. We are back with the management of IRFC, and we'll discuss their 12,800 crore rupee loan deal with Hindustan Urvarkar and Rasayan for debt refinancing. Stay tuned. A conversation with Manoj Kumar Dubey coming up next.
Welcome back. It's a pretty smart recovery underway. Nearly 200 points from the day's low. We're still down about 140 points, but significantly off from the lows. Stocks which are leading it on the way up: defense, BEL has moved up nearly 2%. Reliance Industries has climbed higher by 1.5%. And consumption names like Titan, HUL are also now back in the green, erasing the early morning losses. But let's talk about IRFC. That has signed a signed a refinancing agreement for up to 12,800 crores with HURL, Hindustan Urvarak Rasayan Limited. Manoj Kumar Dubey, Chairman and MD of the company, is now joining in. Thank you very much, sir, for joining in. Tell us a little bit about this joint venture with HURL. What exactly is HURL? And what are the terms of this agreement with you all? And why is it significant for a company like IRFC?
So, good morning, Rima. Thank you for tracking us. So, before closing the FY, this deal happened just last week. HURL is already working fertilizer company, which is promoted by 3 of the giants of CPSCs, that is Coal India Limited, NTPC and IOCL. So all 3 Maharatnas are promoting it. They are already doing business. Cash flow is already positive. So we did the whole, we took over the whole loan portfolio of theirs, and we disbursed around 12,000 crore on last Friday. So this deal is in line of what we started right in the beginning of the FY, where we promised of funding anything which is having a linkage with Indian Railways. All these 3 factories, that is at Gorakhpur, Sindri and Barauni, are linked to the railways, and all movement of fertilizers are taken by the railways. So we did this deal. It is a very good deal, and the asset quality is top class, being promoted by 3 of the Maharatnas. And we are making a very decent profit also out of it.
What are the NIMs, sir? The net interest margins on this particular transaction?
As I always mention you that we are working now in a margin of 100 bips to 125 bips. So this particular deal also will land up in between that, which is again nearly 3 times of what we used to get from the railways.
All right. Hi, sir. Morning. Good to see you in. What about the cost of borrowing? You're saying that the NIMs are similar. How does it change?
That's a very interesting question, Nigel. So, we raised back-to-back 2 ECBs also for 5-year tenure in yen. And I'm very happy to share with you that with its very conservative hedging, the rates have come down to 5.80%, which is very good for us. And when we started the financial year, we set ourselves a target that our cost of borrowing should be near about or below G-SIC rates. So I'm very happy to share with you that we have achieved that, and we have got an excellent deal in ECB market. IRFC always garnered the best of the rates, and the trend continues. During the very turbulent times, we entered into yen market, and I'm very happy to share that with the hedging cost also, we have landed somewhere around 5.8 to 5.9, which is very good rate. 54 EC bond and deep discount zero coupon bond also, we got very good rates and very good market share. All taken together, our cost of borrowing for the whole year, which is we have raised more than 45,000 crores. It is all hovering around 6.5, which is something which you always aspired for.
Okay, all right. How do you see things scale up from here on, sir? In terms of the book increasing, what are the targets, disbursements? How do you see things going ahead? Given that we have a pretty challenging economic scenario that could play out for the coming few months. So in FY27, what are the targets you're laying out?
So, Nigel, for us at IRFC, we believe that the challenges before the geopolitical upheavals that took place were a galore when we started the FY. Because, the traditional single client business was not coming for the last 2-3 years. So we embarked on diversification, and now, as you know, we are ending on a very high, crossing our targets of sanctioning of assets, which was 60,000. Now we have done more than 75,000. And in fact, another 15,000 crore, we are already L1. So it is a complete comfortable situation so far as pipeline is concerned. We set ourselves a target of disbursement of 30,000 crore, which we have exceeded by margins. We have done more than 35,000 crore. Now the pipeline is there, and next year we will be heavily going into the metro business also. We believe that despite the geopolitical situations and the things going around, our business model and India's infra growth story remains intact. And this is not for a year or two. I mean, FY27 also, we are already completely grooved into what we need to do in Q1, Q2, Q3. So there is a lot of clarity in the businesses that we are going to get. And I can only assure you that last FY, our disbursements picked up only in H2 because there was no pipeline. This year, rather, we are in a very comfortable situation, as we know that what disbursement we are going to do in Q1, Q2 also out of our pipeline. And we are also aware that the businesses that we are only negotiating where disbursements will be taking place in Q1, Q2. So overall, I believe that IRFC is going to have a better scenario and a comfortable scenario going forward in FY27.
Okay, all right. And what about the segmental mix? You all were looking at, moving a little bit away from railways. How do you see that pan out?
So, in fact, the whole mix will be going to, in fact, expand. As I mentioned to you, this year we focus on SPVs of the railways, siblings of the railways. We did DFCCIL, we did Angul Sukinda. Then we focus on power value chain who are serving to the railways in Gencos mainly. We did one Transco and many Gencos. Then we did businesses with the JVs of Maharatnas like NTPC, IOCL and GAIL and Coal India. So these were our cherry-picked Maharatnas was JVs we funded. Next year, disbursements will be seen in the arena of ports promoted by government and metro railways and rapid railway in a big way. Apart from that, Nigel, you see, Railways has already announced one more dedicated rail freight corridor between Dankuni to Surat from east to west and 7 high-speed rail corridors. So these together require around 2.5 lakh to 3 lakh crores of investment in next 5 to 7 years. This is primarily our business. Things have started moving in a faster manner. This will be our long-term 5 to 7 year businesses on the platter. But the areas where we have already started funding and the areas I mentioned to you, port and metros, taking all together, multi-model logistic parks also, 27 will be having more broader kind of sectors where we'll be funding, all having linkages with the Indian Railways. So that is how things are going to unfold in next FY for us.
Okay, so thank you very much for joining in. For the markets, as we highlighted, it's been a 200-point recovery on the Nifty from the lows. For the mid-cap index, it's been a 500-point recovery, still down 1%, but significantly off the low. Sugars stocks are racing away to the top. Dwarkesh Sugar 12% up. Sri Renuka is up nearly 7%. Bajaj Hindustan moving up on large volumes, 4.25% higher. Chennai Petro, MRPL, 2 other names which deserve mention for the kind of up move and pretty good volumes. An urban company, which Manglam was telling us, InstaHelp, is scaling up pretty well. Stock has moved up 3%, large volumes relative to what it normally does in the first 1 hour. But let's talk about IT, because it's been now nearly 2 months since Anthropic's Claude update sparked fresh doubts about the company's, the industry's long-term relevance. Now, earnings season will kick off with TCS on 9th of April. And the big question now is, has the pessimism gone too far? Here is a compelling perspective that we got from Christian Klein, who has been the SAP CEO. He's led SAP for over 5 years. And his message is very simple. Long live software. He believes that software is not reaching the end of the line. It's only getting started. And the winners will not be the ones who own marginally better LLMs, foundation models. He's saying AI is making software faster and cheaper to build. Large language models, according to him, will be commoditized. Building an AI agent is now the easy part. The hard part is actually making it work inside an actual business and scaling it up with full control and compliance. So according to him, the winners are not going to be the foundational models which are marginally better, but winners will be those who deliver value at the application level. So he says we speak to so many customers, and every customer wants AI that deeply understands their own business, brings in that contextual knowledge, and can do it securely and reliably. So this requires integrated applications, harmonized business data, clear controls. And without this, AI, he says, operates in a vacuum, disconnected from business reality. And even if there is the smallest mistake, perhaps on the fact that the data is not clean, if you use outdated, incomplete or incorrect data, it can actually result in big wrong decisions. And therefore, he says that if AI has to deliver real results, it needs 3 things: deep business knowledge, clean, reliable data, and strong governance. And this is where software comes in. He's like, software is now becoming the operating system for trusted autonomy. He ends the letter by saying that companies that recognize this will embed AI into the systems that run the world's economy. The rest will run more experiments, generate more prototypes, and they will wonder why the outcomes lag hype. So he's making a compelling case that software companies like SAP and the others, the SaaS companies, which have gotten hit very hard, will be the winners in this entire AI race.
Okay, all right. It's pretty apt that our next discussion, right, kind of sort of picks up on this entire AI story, but not just AI, and looks at the impact all of these new technologies and new trends will have on the Indian middle class. How much they earn and what they're able to spend. So this has got some deep implications for the economy and, of course, consequently, the markets as well. Saurabh Mukherjea is co-founder and CIO at Marcellus Investment Managers. Saurabh, in his new book, which is called Breakpoint, The Crisis of the Middle Class and the Future of Work, writes that Indian middle class has been thinning out. I mean, that's a book up on your screen. He says that, and it's a quote, India's middle class today faces its most vulnerable position since economic liberalization in 1991. And as I said, it's not just AI, but gaps in education, skilling systems, etc., which put this middle class out of touch with what the industry really needs. There's a fair bit of data in there. I mean, the idea, of course, I think has been spoken about for a while, and this kind of sort of, nagging feeling that maybe, just maybe, as we're all being used to, that, the lives of the next generation are always going to be better than the prior generation. Are we at a point where we need to question that? I don't know, but maybe Saurabh has the answer. Saurabh, welcome to the program. Thanks very much for joining us.
Thank you.
It's just that the book has come out at a time when everything is already down and out, Saurabh. So tell us, why did you write the book, and what was the aim and objective? Yeah.
So let me put it in a positive context, Prashant. What happened was, and in a way, it happened partly live on CNBC over the many years that I discussed with you our portfolio in India. Because ours was a consumption-centric portfolio, we could see at very close quarters the consumption slow down, right? There was a COVID in a way muddied the waters. COVID muddied the waters because post-COVID there was a bit of a bounce. But if you take a 10, 15-year view, whether it's of consumer durables growth or FMCG volume growth, the picture is pretty clear. When the Indian middle class was in its heyday, say 10 years ago, volume growth on most items that we used to buy and we used to discuss on your channel would be, say, 11, 12%. Those same products, the same companies' volume growth is now barely 2-3%. And behind that is the story you're narrating, that what we've discovered whilst writing Breakpoint is there's been a secular slowdown, a structural slowdown in white-collar job creation, which in turn is correlated to real wages for people like me, people like the people watching this program. Real wage growth has slowed down. What it presents for India, we think, is a very interesting opportunity, one that we are loading up on actively as we speak. We think the Indian economy will have to tilt from IT services and consumption-centric to manufactured goods-centric. The currency going towards 100 to the dollar, the free trade agreements, the West's suspicion of China, the Western economy's suspicion of China will, over the next decade, make India a manufacturing powerhouse. And our job in that regard has become pretty simple, right? Go to places like Coimbatore, like Surat, like Baroda, like Chennai, and buy good manufacturing companies at 15p or 20p. And as you said, everything's already keeling over. So valuations are no longer the challenge that they were 3-4 months ago. And I think this Sagar Manthan, the reposition of India from being a consumption-led economy to a manufacturing-led economy, that Sagar Manthan is upon us. India's economic model will pivot over the next decade, and we as investors are seeking to position ourselves for that.
Does the data bear that out? Manufacturing as a share of GDP, Saurabh, has remained, these are stats which we usually talk about around the time of the budget or, one of those things, right? It's kind of been remarkably steady. It's not really grown, although this effort to make in India manufacturing, the PLI schemes, etc., are more than a few years old.
Absolutely, Prashant. And manufacturing won't take off until the rupee depreciates meaningfully. The reason for that is simple. If you're exporting $250 billion worth of IT services, and you're getting another $150 billion of remittances from smart Indians living abroad, that $500 billion of foreign exchange inflow makes your currency stronger than it should be. And that in turn makes the life of a manufactured goods exporter very hard. But as IT services gives way for the AI discussion that we were having, right? As IT services growth takes, as the remittances from our friends and relatives abroad tail off, the currency will have to give way. The currency will adjust pretty quickly. And as the currency depreciates, we are becoming competitive with countries like Vietnam, like Bangladesh. I think vis-a-vis China, we have still some way to go. But Vietnam and Bangladesh seem to be in our radar. And I think if the free trade agreements work out in our favor, China too could be on our radar 4-5 years out. So it is one or the other. We can't say we will have strong IT services growth and have strong manufactured services growth. The currency dynamics won't allow that. I think the more likely sequence is IT services growth slows down, perhaps starts degrowing. And that's when manufactured services growth takes off, with the currency acting as the necessary tailwind, along with the FTAs that the government is negotiating, plus the West's hostility vis-a-vis China.
Saurabh, two questions. One, why can't both, so IT doesn't go off the radar, but I mean, it's already been slow growth for a few years now, right? And it continues in that middling fashion. And export of manufactured goods really picks up. I mean, both can coexist, right? You said, well, it's that or this.
It's tough because see, remember our land prices, India's industrial land prices, Prashant, are a good 40%, 30% higher than Vietnam. In fact, our land prices in developed states like Maharashtra, Gujarat, our industrial land prices almost rival Europe now, right? So we've got expensive land, courtesy minimum wage laws. Our labor is also pretty expensive relative to its modest productivity. And finally, our working capital costs. Our working capital costs are 3-4x that of many other Asian countries. So given that our capital is so much more expensive, our land is so much more expensive, the only way our manufactured goods sector will take off is if the currency depreciates appreciably to give our exporters an advantage, right? So that's the piece which was missing for many years. That's the piece that the free market will deliver. It doesn't have to, whether breakpoint sells or not, right? The currency will give way, and a depreciated currency, like it did for China, like it did for Taiwan, a depreciated rupee will give the Indian manufacturing sector a leg up. And that's the Sagar Manthan, right? New centers of prosperity in Coimbatore, Surat, Baroda, Chennai will emerge. And the old IT hubs, say Hyderabad, Bangalore, Pune, they are bound to see some degree of economic dislocation as we go through this Sagar Manthan in our country.
So, in terms of talk about investment implications, Saurabh, you said we are moving and you're already finding attractive opportunities in these manufactured exports area. And I'll ask you which ones, but just one moment more on, because you do point out in the book consumption, which perhaps is at a risk. What does that mean for lots of things, which, the entire consumption basket, which is what the India equity story has historically been based on, Saurabh? And which are the parts which are most vulnerable if your thesis proves to be correct?
Sure. So I think, look, the entire construct around FMCG, building materials, which people like me itself built, right? People, investors like me with our books and our investments through the 2010 to 2020 period, where jobs were growing strongly, consumption was growing strongly. That piece did remarkably well. That piece is obviously now going to slow down as the white-collar jobs piece comes off. And therefore, the valuation derating that we are seeing, both at the market level and at the consumer-centric level, I think the valuation derating continues. The reverse applies to the manufactured export sector. You're getting plenty of good companies at 15-20 P, which I think will re-rate over the next decade.
Yeah. So this includes financials, etc., as well, which is a large part.
Yes, I think the answer there is true. I think there is plenty of middle class lending which goes through the balance sheets of India's financial services providers. I think banks and NBFCs across the piece, I think we will see pressure on retail NPAs as this story plays out. As the dislocation of the white collar job sector plays out, I think we will see pressure on retail NPAs across banks and NBFCs.
Saurabh, one quick question. The counter to the collapse of consumption, as seen with the numbers of, say, FMCG companies, staples, etc., is that the form of spending has changed. People are spending far more on travel, dining, experiences, subscription. So what are your thoughts on that? Isn't that also where India is spending now, which is not getting captured in, say, the numbers of the listed companies?
So again, if you see the numbers there, right? So let's take, say, airline ticket growth. We had a good 3 years post-COVID. We had a good 3 years, but even that piece has now slowed down as we get deeper and deeper into the white collar jobs slowdown, and the effects of AI on generalized employment play out. You're seeing even sectors like airline ticket growth. Even that is coming off, right? So you're right to say there was some degree of experiential consumption which had kicked in. But as the debt burden, we have now the world's most indebted middle class, as the debt burden proves too much, and as we pull away from the post-COVID euphoria, by and large, across the piece, you're seeing a secular slowdown in consumption. There is nothing surprising in that, right? If you can't create white-collar jobs, and we can't as a country, we can't create white-collar jobs, you can't add infinitum fuel consumption through people borrowing more and more. At some stage, the party comes to an end. And the beauty of free market economics is the free market does the adjustment for you. The currency conks off, the government steps in, negotiates good FTAs, and a new slice of the economy takes off around manufactured exports.
Yeah. So just you want to leave us with a few names, Saurabh? Which are these stocks?
Sure. So the companies that we've historically invested in for a fair while, and we're thinking of buying more if these share prices come off. So Divi's Lab in APIs would be a traditional name that we've been long-standing holders. The entire piece around pharmaceuticals, the ancillary supplying into pharmaceuticals, organic chemical companies, that ecosystem, I think, will do very well. Divi's has a supplier called Acuitas. We've been long-standing shareholders there as well. These two are expensive names, but look for similar plays around CDMO, around APIs, and I think you'll find plenty of sources of promise there. Then the second area is auto OEMs and auto ancillaries. I think the EU FTA is a wonderful FTA, and I'm hoping that our investments in companies like Escorts, Kubota, like their suppliers, should do well. And the third area is engineering products. We've become shareholders in LG Equipment and Triveni Turbines. We're hoping that LG, Triveni, and other engineering companies do well in the post EU and UK FTA format. There's plenty there for us to play for as the EU and UK FTAs kick in next year.
We could go on. It's an interesting chat, Saurabh, and we'll probably have you back to pick on some of the specifics as far as this book is concerned. Thank you very much for joining us. That's Saurabh's new book, Breakpoint: The Crisis with the Middle Class and the Future of Work. And Saurabh, of course, highlighting the pitfalls, if I can put it like that, the weak points, but also how to kind of sort of pivot away to benefit from some of the opportunities which he thinks will come up, and manufactured exports is the big one that he's pointing to. Well, I think Nagaraj Sethi is with us of HDFC Securities with a quick perspective on things on technicals. I think markets are down 160 points, 170 points, 22,650. Nagaraj, what would you do?
Hi, good morning, Prashant. Market is just echoing the Middle East conflict. No respite for bulls, even though after declining so much on the lower levels. Market is finding small support around 22,500 odd level, which is the previous swing low, as well as the opening upside gap of 11th April 2025. Just a bounce back. We have seen strong supports are offering a smaller bounce back, and eventually market is forming, Nifty is forming lower tops and eventually coming down the lower bottom. I'm not expecting a bigger upside from here onwards, just a minor upside recovery towards 22,800, 900 levels, and eventually we could see Nifty sliding below 22,500, 450 supports in the near term.
Stocks, Nagaraj?
Yeah, I have two stocks from my side. One is from pharma side, Natco Pharma. Chartically, Natco Pharma has been in a strong uptrend, a larger degree, higher tops and bottoms. We have seen some consolidation has happened, and the stock has bounced back in today's session very well from the lower levels. Currently trading around 1,003. One can look to buy at this point of time. 1,060 is going to be the immediate target. One can place a stop loss at 970. And second one is from a sell side, Sona BLW. Has been in a consolidation phase recently with a larger move, broken below the consolidation around 480, looking good for a shorting opportunity. One can look to sell at this point of time. Currently trading around 475, 475.50, 476. One can look to sell at this point of time. Immediate target would be around 450, and one can place a stop loss at 490.
All right, Nagaraj, we'll leave the conversation here for now. Thank you for joining in. On the other side, Manish Gupta will join in to focus on commodities. Stay tuned. Welcome back. Let's talk commodities now. Manisha is now joining in, and we're seeing big price moves across many commodities, the entire complex today, Manisha.
Well, absolutely. Since it's a financial year ending, I'm just bringing to you all those commodities that have actually done well. And if you look at the last 12 months or last 1 year, almost everything in commodity pack actually has done very, very well. That is the energies in front of you, and we're looking at 43 to 55% of gains for both the crude varieties. But the major gains clearly have come in for the crude derivatives. So whether it is about gasoline, heating oil, it's gained more than 80 to 100% in the last 1 year. Coal also has been surging. The last couple of years were not so great for coal, but with the kind of energy concerns that we are living with, coal prices also are up by nearly 39% in the last 1 year. Let me break it down and look at what the month of March and the current quarter has done in sense of energy prices. So there you have it. More of the gains have come in for the last 1 month itself. So 40 to 50% of a jump in the month of March is what we've seen in the crude prices and heating oil. If you look at this current quarter or 2026 as a calendar year till time, you're looking at 70 and 90 and 100% of gains for many of the crude and varieties. And there you have coal, 12% up for the month of March, and that also has gained up by 34% in this year till time. Let's take a look at the precious metal prices then, or rather the crude impact prices first of all. With the crude prices surging, we've seen many of these commodity prices also continue to gain. So you have sugar prices, which actually has given you 2 years of decline. In the last financial year, we've seen sugar prices also gain up. For the month of March, 13% of gains coming in for this one. Synthetic rubber prices, where you use crude, also has gained up by 40%. That is polythene prices, 32% of gains there. And sulfur, one of the major fertilizers, also is looking at multi-year highs in sense of futures in the international markets therein. The World Container Index is 16% up, and the containerized freight is gained up by 37%, all in the matter of just 1 month, in the month of March therein. And now you should be looking at precious metal prices. So last 12 months have been amazing. We've seen record highs come in for gold and silver and platinum and multi-highs in palladium as well. So 43% up for gold, 100% up for silver. And you're looking at very strong gains coming in for PGMs like platinum and palladium. But when you look at the month of March and this current quarter, that hasn't been so well. Actually, the kind of profits that you saw in gold and silver got sold into one. There may be no rate cut from the US Fed and various other central banks. And then it also is about paying off your losses elsewhere. And that got a decline in the precious metal prices for the month of March. So much so that barring gold, silver, platinum, palladium are now negative for 2026. And finally, the base metal prices should come in on your screens as well. So when you look at the last 12 months, well, yes, it has been good. 8% of gains in copper, 28% of gains in aluminum. Aluminum actually is performing in the short term and the longer term as well. And you should actually see the prices for this month and for 2026 as well when it comes to the base metal prices therein. So for the month of March, we are negative in copper, in zinc, in nickel, lead, tin, all of those. Aluminum is the only one performer. 9 to 10% of aluminum comes in from Middle East, and we do understand that 3 major companies and smelters have shut their facilities because of damages there, and that has led to aluminum outperforming for the year as well till time. So while copper has turned negative for 2026 with the kind of gains that we're looking at in the month of March, aluminum is the positive. Zinc just about trading in positive there, but aluminum clearly outperforming within the metal space, and then it is about the Brent crude prices trading very, very firm.
All right, Manisha, thank you very much for that. That's, the commodities picture as things stand right now. We'll take a quick commercial break here. We'll come back. Lata in conversation with Neeraj Gambhir of Axis Bank and Abhishek Upadhyay of ICICI Securities. PD as RBI's move has pushed the rupee higher this morning. So many angles to it. What next after today's bump up? Is it here to stay? And more coming up in that discussion after a quick break.